US cents.
Okay, for more on finance now, we are joined by James Gerrard from financialadvisor.com.au. Good morning to you. Let's start by talking about tax and super, and it's fair to say they've been in the headlines a lot this week.
That's right. Good morning, Catherine. Well, federal parliament resumes next week, and Labor will be very keen to get their divisive Division 296 tax through the Senate, having already gone through the lower house before the last federal election. Now, we have to remember that you need 39 votes to pass legislation in the Senate, and Labor have 29 senators in the new Senate, Greens have 10, and there's 10 crossbenchers. So Labor will have multiple pathways to get this Division 296 tax through the Senate and into law. And just as a reminder of what Division 296 tax is, it's a new wealth tax inside a super that affects larger super balances above $3 million, whereby there'll be a 30% tax on income and gains. But what has upset some people is that it'll also apply to unrealised gains. So there'll be an annual taxing event on any increase in value on people's super above $3 million. But what some savvy Australians have done is they've started to think ahead of this tax, because the government anticipate that they'll generate $2.3 billion per year from this tax and $40 billion over the next 10 years. So what this group of Australians who have self-managed super funds are doing is that they're understanding the super laws and using those to their advantage to try and counteract this new potential tax. So they're adding their children as members to their self-managed super fund. You can have up to 6 members of a self-managed super fund. So that's step number 1. Step number 2 is that for people that are over the age of 60 and retired, they're pulling money out of super, which they can do tax-free. They're giving it to their children, and then they're saying to their children, put it back into my super fund. And the reason why they would do that is that although the super fund balance stays the same, the member splits differ. So the person with a lot of super now has less super, and the child now has established a super balance. Now, there are some risks with that, in that the child may just take the money and run off with it, but also there's administrative hassles as well. When you add more people to your own self-managed super fund, every member needs to sign annual trust statements, tax returns, audits, so it becomes a little bit more complicated to run the super fund. And final thing to remember there is that the legislation hasn't passed through the Senate. There may be some negotiating with the Greens or the crossbenchers, so people shouldn't do anything yet. They should just wait and see the legislation come through, and then they can make the decisions as to what they do and, of course, get professional advice.